It's been an underwhelming first half of the year for oil prices, but with US crude trading just below the $80 mark, what can we expect in the next few months? Hello and welcome back to our channel. My name is Daniela Hathorn. In today's video, we are going to be doing a little bit of a longer term forecast on oil, specifically looking at the chart of US crude to see what we can potentially expect or watch out for in the coming months. But before we get into it, please like this video, comment, subscribe, and turn on your notifications. So with regards to oil, it's been, as I said, a little bit underwhelming the beginning of the year. We've seen oil trading for most of it within a tight range. We've seen US crude trading below $80 per barrel pretty much throughout the start of 2023. There were a few instances at the beginning of the year where we tried to push above that $80 mark. We didn't quite manage that, seeing a lot of resistance along that area. And despite having some volatility throughout that period, for example, seeing the OPEC plus production cuts, which spiked oil prices. We also saw the lackluster reopening of China, which despite there being a lot of hype around, we didn't actually see some of that great demand materialize. So we have seen some volatility in the period, but throughout most of it, especially if you compare it to 2022, which was a period of the energy crisis and that spike in energy prices, the start of 2023 has been slightly more of a consolidation phase so far. Now, the start of July has seen US crude push back to that $80 mark. The last time we were trading around that area was back in April when we saw OPEC plus announcing further production cuts. Now, in terms of the momentum, a lot of it, especially in the last month, has been driven by the dollar side of the trade. We've seen a lot of dollar weakness, especially with that drop in US CPI and US PPI in June. That, of course, shaping the rate curve, especially those expectations in the coming months as to the Fed pivot. We've seen the Federal Reserve meeting on Wednesday. We saw them hike 25 basis points. But in terms of the future guidance, we saw Powell saying that the decision is going to be data dependent. And if we're looking at data, yes, we do have a resilient economy. The jobs market remains tight. Growth remains supported. But inflation has, in fact, tricked down nicely. It's now at around 3%, which is the upper bound of the Fed's target. Core inflation remains a little bit sticky, but nonetheless, still dropping nicely. Of course, the amount of rate hikes that we've seen in the last year from the Federal Reserve still needs to show its full effect on the economy. So is the Federal Reserve going to hold for a couple more meetings to see how that evolves, potentially leaving the door open for further rate hikes? That seems the case at the moment. On the back of that, we've seen a little bit of weakness in the US dollar. Oil hasn't really done much. It's trying to push higher in the aftermath of the meeting, up around 1% since then, but not really showing the most momentum overall. So in terms of forecasts for oil, again, it's going to be that playoff between demand and supply. Of course, the dollar side of it is very important. We'll need to keep our eye out on the dollar. But in terms of the specific fundamentals for oil, demand and supply, in the first half of 2023, we've seen a boom of services demand in the oil sector, but manufacturing has been lagging. We know manufacturing was very strong in the aftermath of the COVID pandemic, but with all of those supply shocks, we have seen manufacturing lagging. Services is picking up the bulk of that drop in manufacturing. There seems to be still sufficient enough disposable income that spending is held up so far, especially within the summer period. But looking at the third quarter, especially towards the end of the third quarter, as we head into the autumn period and the fourth quarter, we could see demand for oil drop, especially as spending could slow in those months in the next 3-4 months. So if we do see that slow in spending, we could see demand for oil drop even further, which may indice a reaction from OPEC plus countries. Now, despite most likely looking like the US is going to avoid a recession, at least for the time being, which would be the worst case scenario for oil. It's being an economically sensitive commodity. The fact that spending could slow in the coming months will, of course, have an impact on prices. As I said, it's very sensitive to the evolution of the economy. And even though avoiding an outright recession, that slow in growth could see oil prices weighed on a little bit. So that is when we're looking at demand, what can happen. Now, we have seen some comments recently in the last few days from the International Energy Forum saying that there's going to be serious problems for supply to meet demand in the coming months, and that is going to create a big price spike. They are backing this on the fact that China and India are going to be increasing their demand by 2 million barrels per day in the coming months, which is going to cause a massive drop in inventory and leave that supply gut, which will in turn increase prices. So far, China's highly anticipated reopening has been slightly lackluster. It's failed to provide any meaningful boost for oil prices, but forecasts from these International Energy Forum officials suggesting that may be the case. But if we're looking at inventories, actually, the drop in inventories has been quite underwhelming. In fact, US crude inventories dropped 0.6 million barrels in the week finishing last Friday, July 21st, when expectations were for that drop to be of 2.3 million. So very underwhelming drop in inventories. In fact, in the previous weeks, we've seen a massive rise, I think 5 million barrels, which is way above forecast. So it seems like inventory isn't yet showing those issues, that discordance between supply and demand. It may just be a cry to bring attention to the industry, but nonetheless, some forecasts suggesting that the third and fourth quarter are going to see a very big rise in oil prices. When asked whether it would get to $100 per barrel by the end of the year, they said that currently trading at around $80, it wasn't a far cry from where we are now. So those are some forecasts. But we did see in May the Energy Information Administration slash the price forecast for US crude for the second half, given that oil prices have been so subdued in the first 6 months of the year. So all in all, from the demand side, we could see households having to reduce their spending, especially now that disposable income is going to start to fall, given the amount of higher costs and cost of living crisis, really, that we've seen over the last year or so. So that slowing in spending could weigh on prices. But at the same time, some organizations forecasting a big rise in prices, given a supply gut that may happen over the coming months. So let's jump onto the chart now to see how it's been trading. So here we have the US crude daily chart. As you can see here, starting from the beginning of January, you can see a little bit of a tight range here in the first 2.5 months of the year. We then saw that drop within that SPR replenishment price range, picking up once again towards the end of March. This is that jump that we saw on the announcement of OPEC Plus supply cuts. Really didn't manage to sustain that bounce higher and then coming back down within that range and consolidation up until the end of June, beginning of July, when we've seen a lot of that weakness in the dollar, and also the fact that the US economy has remained resilient, has seen a lot of risk on appetite in markets. We've seen stocks rallying. We've seen the likes of Eurodollar and cable pushing higher. So, of course, oil has also benefited from that. We've seen some resistance along the way, most notably the 200-day simple moving average, as you can see, currently trading at 76.5. We did manage to clear that, which in itself is a significant achievement, because you can see the last time we attempted that was back here in April with that OPEC Plus price surge. We didn't actually manage to get a significant close above that level, let alone a push higher, which we have seen in the last few days. So that in itself is pretty significant. The last time we traded comfortably above the 200-day simple moving average was back here in July last year. So for the first time in a year, we're now trading above that 200-day SMA. Also within that, pushing higher, but starting to near a key area of resistance here between 80.65 and 82.54. as you can see, it's been very relevant and significant ever since we broke below it back here in November last year. In December, we tried to push higher, found some resistance on the upper bound of this range. Back here again in January, trading within that area for a few days. Also in March, stopped by the lower bound as we did in February. As I said, in April, we did manage to spike above it for a session, but really struggled to get a close above that 82.5 area. And now starting to go back into it as we see that bullish momentum rise. So we do have a lot of resistance up ahead. First of all, the $80 mark, it's quite a significant psychological round number, so that in itself. But then we head straight into this key area of resistance, which is going to be quite tough to clear, even if we do see those buyers coming in force. So watch out for that. That's likely also to be a key area of a take profits or stop losses. People have set their support and resistance levels. Also something to watch out for, you can see the RSI. Every time we've neared that 70 overbought area in the last year or so, we've seen a pullback ensue. We saw it back here in last week. I was talking about this actually. We bounced off that 200-day simple moving average, which coincided with the RSI nearing that 70 mark. We did see a little bit of pullback there, but not really undoing a lot of this overbought pressure. So we're now heading back towards that 70 line. We actually haven't managed to cross it since March last year. Every time we've neared it, we've seen that pullback, which has then undone some of that overbought condition. So it'll be interesting to see if we actually manage to cross above it this time. If we do, I think that puts a lot of selling pressure on oil. I think we need a little bit of a pullback to reinstate some of those conditions. Back towards that 50 midline is likely before pushing higher once again. So overall, the chart is giving us a little bit of a exhaustion pattern. As I said, with that key resistance up ahead, the fact that over the last 3 trading sessions, we've also seen a little bit of a sideways consolidation here, trading within a short-term range, suggesting that those sellers are out in force and actually making it hard for buyers to push higher. In terms of the longer-term forecast, as I was saying, there have been some reports suggesting that it could push up all the way to $100 per barrel. We haven't actually traded there since July last year. It is a significant move. And I think, as I said, there is a lot of resistance up ahead. But it all depends on how the momentum continues to build. I think fundamentally, there is still a little bit of weakness ahead in the market. As I said, demand could start to slow even further. We're not really seeing that drop in inventories that's been forecasted just yet. So I would say take it easy step by step. A lot of risk management necessarily, especially if you're forecasting that rise to 100. As I said, oil is very economically sensitive and therefore can be quite volatile at times. So yes, there could be potential to see a bullish drive all the way to 100, but I think that's still a little bit of a long way away. I think there's a little bit of pullback still within the price range before we actually can start to consider that. First of all, trying to clear this resistance here. Conversely, we could see further weakness come, whether that may be in the case of recession fears peaking once again, or we see the Federal Reserve actually hiking more than anticipated. We see the dollar finding some strength, those risk on assets like oil coming back down. If that were the case, expect to see a little bit of support where we've been trading sideways in the last few months. Just around that $70 mark, we could see those buyers coming in, trying to take advantage of that better price level to come in. Also, that SPR replenishment range, we're back within that as well. So we could see, as I said, that weakness coming in, but I think there is a fair amount of support if that were the case over the coming months. That is it for the second half forecast for oil prices. Thank you so much for watching, and don't forget to subscribe to our channel.